Welcome back to the channel where we dive deep into the world of finance to help you make well-informed decisions. Today we've got a great topic. We're going to be talking about how to ensure when you're purchasing a whole life insurance policy, how to make sure that you're purchasing a policy that is going to perform well. And more specifically, we want a high cash value and a cash value that's going to be extremely efficient moving forward. Whole life insurance is a type of permanent life insurance that not only provides a death benefit, but also has a cash component to it. Most of the clients that I'm working with that are utilizing these policies use that cash value component to take loans out and invest in other alternative assets that produce cash flow. Funnel that money back into the policy to replenish their opportunity fund, to go out and repeat that process to create more and more wealth. This is a great way to get a guaranteed 5-6% return inside of the policy. And in addition to that, take that money and use it in a different place, creating wealth in a different asset. Very literally, you begin earning money in the policy and earning money outside in the investment or the asset. So you're earning money in two different places at the same time with the exact same dollar. Let's break down what you need to be looking for when looking into these policies and how to choose the right insurance company. First, you need to make sure you consider the company's financial strength. You want a company that's been around for a very long time. All the companies that I work with have been around at least 100 years. That's something that's pretty consistent throughout the industry. There's at least a dozen companies that meet that criteria. In addition to that, you want them to have very good ratings, particularly looking at AM Best and or Moody's. Look at those two ratings agencies. Make sure they have an A rating or better. In addition to that, you want to be working with a mutual life insurance company and also an insurance company that's consistent in paying dividends. Secondly, you want to make sure that you understand the policy fees and costs associated with the policy. All insurance companies are going to have fees and costs associated with the policy. Some of them front load those costs a little bit heavier in the initial few years. Others spread that cost out throughout the life of the policy, and some even have a higher cost as the policy goes on. Third, focus on the flexibility of the premium payments. When you're structuring a policy for high cash value, there should be quite a bit of flexibility in terms of how much you can fund that policy. Not only at how much you can fund, but how little you can fund. And also, it's important to know how long you can fund if there's a time frame set on that. Some companies have policies that are called 7 pays or 10 pays or 20 pays, where you only have that specified amount of time to fund. Other companies have a lot more flexibility and allow you to fund really as long as you'd like, up to about age 100 is usually where that cutoff is. Now, how can you tell if a policy is built in your favor? Here are 5 indicators that will help you know that the policy was built for high cash value and optimized for your growth. The number 1 indicator is the initial cash value that is created that first year. A lot of companies can produce at a minimum 70% of what you fund into the policy should be available in cash value that very first year. Some companies can even get as high as 90%. So make sure that that cash value is sitting at least at minimum of 70%. If it's sitting below 70% of what you put in that first year and you're under the age of 65 years old, it's not a well-built policy. Now, a fair question may be, how do I decide between a company that's showing 75% of my initial contribution available in cash value and a company that's showing 90% of what I put in? Initially, that sounds like a pretty easy decision. The 90% one seems like it's going to be a much better option. That's not always the case. You want to make sure you look at not only the initial cash value, but the long-term IRR on the policy. Because some companies can provide a much higher initial cash value, but then later on those costs come out and hit that cash value pretty hard in the later years, while others might have a higher initial cost that first, second year. However, the costs drop off significantly over time and that cash value starts generating a much more efficient growth inside of the policy itself. So it's important to look at both the initial cash value and the long-term internal rate of return. The second thing you want to look at is the guaranteed growth rate. Make sure ever whole life insurance policy you're purchasing has a guaranteed growth rate. Most will be between 2% up to about 3.75% depending on the company. The guaranteed portion isn't the only thing you want to be looking at in this, but you do want a good guaranteed rate. Most companies that we're working with have about a 3% guarantee or a contractual guarantee that they promise to credit you every single year, that 3%. But it's important to know exactly what that guaranteed growth rate is and that it's there in the policy for you. That brings me to my third most important thing to look at, which would be that there is a dividend being paid. Again, you want to be working with a mutual life insurance company. The reason you want to be working with a mutual life insurance company is because as that company is profitable every single year, they're going to give you a dividend as a mutual whole life insurance policy holder. That's going to increase your rate of return. So let me be clear, you have the guaranteed rate, which let's call it 3% on average for these companies. And then on top of that, you get a dividend, an extra on top of that 3% guarantee, assuming that the company's profitable. Again, most of the companies that I'm working with, well, all the companies I'm working with are A-rated, financially strong, they've been around over 100 years. And the important thing is they are consistent in paying dividends every single year through every environment, every financial environment. We're talking about they've paid dividends through Great Depressions, World Wars, high interest rate environments, the Great Recession in 08. They have always paid a dividend every single year since they started. So it's important to know that you're working with a mutual insurance company that have solid dividends and a solid history of paying dividends. Fourth, you want to make sure that you understand the loan provision on the policies. If you're utilizing this as a high cash value policy, the likelihood of you taking the loan out on the policy is very high, right? Most people that I'm working with, that's the sole purpose behind doing it. The death benefit is definitely an added benefit, but the sole purpose is that cash value and the loan provision on it. So you want to make sure you understand exactly what that loan provision is. You want to understand if that's a variable rate on the loan provision. And in addition to that, you want to understand the terms of that loan and how that loan rate is calculated with the insurance company. Lastly, the fifth most important thing you want to be looking out for is the transparency and communication with these insurance companies. If these insurance companies and agents and or advisors, whoever you're working with, if they're being open and transparent and answering all of your questions, they are likely acting in your best interest. Now, bring up the hard questions. It's important to talk through the hard questions and say, ask about the cash value in the initial year, ask about the internal rate of return. These are all things that they should be able to provide you with. If they're hesitating or balking at that, it may be a good idea to go get a second or a third opinion. If they're transparent with you and they're open to answering those questions and they go back and they get those answers for you, it's a very high likelihood that they are acting in your best interest and building a policy that is going to work really well for you. Choosing a whole life insurance policy is a very significant decision. You want to make sure that you do your research, make sure you understand what options you have with different companies, and make sure you get a handful of options of different companies and of different policies. By doing this, you're giving yourself a very good opportunity to get a great, efficient policy that you can utilize not only for your life, but when the death benefit pays out, it's going to become a great benefit to your legacy or your children. Thank you for watching. Remember, whole life insurance is an extremely useful tool, assuming that it has been built for high cash value and in an efficient way. If you found this video helpful, remember to hit that like button, subscribe, and turn on those post notifications, and we'll see you on the next video.